International Public Sector Accounting Standard 3, or Ipsas 3, is a critical standard that guides how public sector entities report their financial performance. Its full title is Accounting Policies, Changes in Accounting Estimates and Errors. This standard establishes the criteria for selecting and changing accounting policies. It also provides rules on how to account for and disclose changes in estimates and corrections of errors from prior periods. The main goal of Ipsas 3 is to improve the relevance, reliability, and comparability of a government's financial statements over time. This ensures that users of these reports, such as citizens, legislators, and international lenders, can make informed decisions based on consistent and accurate information, which is a key element of good governance. The importance of Ipsas 3 really cannot be overstated in the context of modernizing government accounting. It acts as a rulebook that prevents entities from arbitrarily changing how they report financial information to paint a rosier picture. By requiring clear disclosure for any changes, it promotes transparency. For instance, if a government changes how it estimates the useful life of its infrastructure, like roads or bridges, Ipsas 3 requires a clear explanation. This helps stakeholders understand the impact of that change on the financial statements. This level of detail is fundamental for holding public officials accountable for their management of public resources and for fostering trust between the government and its people. A core concept within Ipsas 3 is materiality, which determines whether an omission or misstatement could influence the decisions of users. An important development occurred on May 19, 2025, when the International Public Sector Accounting Standards Board issued Exposure Draft 93. This proposal aims to align the definition of materiality across all standards with its conceptual framework. For Pakistan, this means preparers of financial statements will need to apply a more consistent and clear judgment when deciding if an error or a change in policy is significant enough to report. This recent proposal, with a comment period that just ended yesterday on July 14, 2025, shows how these international standards are constantly evolving to improve public financial reporting globally. Ultimately, Ipsas 3 and its related principles are designed to move public sector accounting away from simple cash tracking towards a more comprehensive view of a government's financial health. It forces entities to look not just at cash coming in and out, but also at the long-term implications of their decisions. This includes recognizing liabilities for future employee pensions or the depreciation of public assets. By setting clear guidelines for policy changes and error corrections, Ipsas 3 ensures that the financial story told by the government is both complete and trustworthy. This provides a solid foundation for better economic management and enhanced public accountability, which are goals every developing nation, including Pakistan, strives to achieve. Pakistan has taken a significant step in its public sector accounting reform by adopting the cash-basis version of Ipsas. This approach primarily records transactions when cash is received or paid out. For a developing country, this was a logical and pragmatic first move. It is simpler to implement than full accrual accounting and often satisfies the initial requirements set by international financial institutions like the World Bank and the International Monetary Fund. Adopting cash-basis Ipsas enabled Pakistan to standardize its financial reporting to some extent and improve its eligibility for foreign aid and loans. It represents a foundational stage in a longer journey toward greater financial transparency and more sophisticated economic management. However, the cash-basis system has significant limitations that are becoming increasingly apparent. This method provides an incomplete picture of the government's true financial position because it ignores non-cash transactions. For example, it does not record long-term liabilities like public employee pension obligations until the cash is actually paid out, potentially decades later. Similarly, it doesn't account for the depreciation of major assets such as highways, dams, or public buildings. This means the government's balance sheet does not reflect the wearing out of these valuable resources, leading to a distorted view of the nation's net worth and future financial commitments. The reliance on cash-basis Ipsas creates a gap in decision-making incentives for public managers. Since the system only tracks cash flows, there is little motivation to manage long-term assets and liabilities effectively. A manager could, for instance, delay essential maintenance on a public hospital to save cash in the current year, making their budget look good. However, this decision leads to much higher repair costs in the future, a liability that the cash-basis system fails to capture until it is too late. This focus on short-term cash management can undermine long-term fiscal sustainability and lead to poor stewardship of public assets. which is a major concern for Pakistan's development. Therefore, while Pakistan's adoption of cash-basis Ipsas was a necessary and positive reform, it should be viewed as a transitional phase. It has laid the groundwork for better financial discipline, but does not provide the comprehensive information needed for robust, long-term economic planning. The system's inability to capture the full scope of government operations, assets, and liabilities means that policymakers are working with incomplete data. To achieve deeper levels of transparency, accountability, and sustainable fiscal health, the next logical and essential step is to begin a carefully planned transition towards the more comprehensive accrual-based Ipsas framework, including the full application of standards like Ipsas 3. The transition from a cash-based system to full accrual accounting under IPSAs presents substantial challenges for Pakistan, primarily stemming from resource constraints. Implementing accrual accounting is a complex and expensive undertaking. It requires a significant investment in modernizing IT infrastructure to handle more sophisticated data, such as tracking asset depreciation and long-term liabilities. Furthermore, there is a severe shortage of public sector accountants and auditors with the technical expertise and training required for accrual-based reporting. These limitations in financial and human resources create a major barrier to the uniform and effective application of these advanced accounting standards across all levels of government, from federal to provincial and local. Beyond resources, Pakistan faces significant institutional and cultural obstacles. A successful transition to accrual accounting depends heavily on the quality of public administration, a strong legal framework that mandates compliance, and a culture of openness within government. There can be resistance to change from officials who are accustomed to the simpler cash-based system or who may be concerned that greater transparency will expose inefficiencies or mismanagement. Overcoming this inertia requires strong political will and a concerted effort to engage all stakeholders, including civil servants, politicians, and the public, to build support for the reforms and demonstrate their long-term benefits for the country. The lack of capacity is perhaps the most critical challenge. Public sector employees need comprehensive and continuous training to understand the principles of accrual accounting and the specific requirements of standards like Ipsas 3. This is not just a one-time event. It requires developing a sustainable training program and updating university curricula to produce a new generation of accountants skilled in public sector finance. Furthermore, collaboration with the Office of the Auditor General of Pakistan is essential to strengthen accountability mechanisms. Auditors must also be equipped with the skills to audit complex accrual-based financial statements, ensuring that the new system operates with integrity and credibility. Finally, the pressure from international organizations, while a driver for reform, can also present a challenge. This phenomenon, known as coercive isomorphism, occurs when bodies like the IMF and World Bank tie financial aid to the adoption of international standards. While this encourages reform, it can lead to a box-ticking approach where standards are formally adopted without being fully or effectively implemented in practice. To avoid this pitfall, Pakistan must own its reform agenda, ensuring that the transition is context-sensitive and adapted to its specific needs and capacity. The goal should not be mere compliance, but genuine improvement in public financial management. Embracing a full accrual-based Ipsas framework offers transformative benefits that are crucial for Pakistan's economic and social development. The foremost advantage is a dramatic improvement in transparency and accountability. By requiring the government to report all of its assets and liabilities, accrual accounting provides a complete and honest picture of its financial health. This allows citizens, civil society, and legislators to see the true cost of government programs and the long-term consequences of policy decisions. This heightened transparency is a powerful tool for controlling corruption, as it makes it much more difficult to hide mismanagement or misappropriation of public funds when all economic events are recorded. Furthermore, adopting globally recognized standards like accrual-based Ipsas can significantly enhance Pakistan's access to international finance. Foreign investors and multilateral donors like the World Bank place a high premium on reliable and comparable financial data. When a country's public financial statements are prepared according to these rigorous standards, it signals a commitment to good governance and fiscal responsibility. This boosts creditor confidence, potentially leading to lower borrowing costs, increased foreign direct investment, and more favorable terms for development aid. This improved access to capital is essential for funding critical infrastructure projects and social programs that can drive sustainable growth across the nation. To realize these benefits, Pakistan's policymakers should adopt a strategic and phased approach to the transition. A big bang switch from cash to accrual is often impractical and risky. Instead, a gradual implementation plan, perhaps starting with certain ministries or types of transactions, would allow the country to build capacity and learn from experience. This approach must be supported by a robust investment in capacity building, including extensive training for public finance officials and the modernization of financial information systems. Additionally, staying informed about evolving standards such as the IPSASB's recent proposals on materiality is crucial for ensuring the reforms remain current and effective. Ultimately, the journey toward full accrual accounting is more than just a technical exercise. It is fundamental to strengthening Pakistan's governance and securing its future. Better financial information leads to better decision-making, ensuring that scarce public resources are allocated efficiently and effectively to meet the needs of the population. It fosters a culture of accountability that empowers citizens and strengthens democratic institutions. By committing to this path of reform, Pakistan can build a more resilient, transparent, and prosperous state, creating a stable foundation for generations to come. The effort required is immense, but the rewards are indispensable for the nation's long-term progress.